When you hear people talk about trading or investing with options contracts, do you wish you knew what they were talking about or how to buy them? Maybe you know of them but don't understand the allure. Well, today I would like to help options contracts seem less formidable and show how valuable and versatile they can be for you long term. This is my first video in a series about options and how you can use them to your advantage. If that content interests you, please like and subscribe for future videos. This first video in the series is intended for beginners or those on the fence. Today we will be asking and answering what are options, why use them, how risky are they, where you can buy them, and how to get your account ready for your first options trade. It's likely you already understand the basics of options. Have you ever made a bet with someone about something that you believe is going to happen in the future? Let's say you bet 50 bucks on the outcome of a big game. An options contract is basically a bet between a buyer and seller, just like that bet you've made in the past. The buyer and seller believe in different outcomes and are on the opposite sides of an options contract. After the bet that you made concluded, one of you had to deliver, right? Well, that general idea applies to an options contract as well. The buyer of an option pays their money up front in the form of a non-refundable premium, which the seller immediately receives and gets to keep regardless of the outcome of the bet. If the bet goes in the buyer's favor, the seller is obligated to deliver on the contract at or before expiration, but the seller never has to return the initial non-refundable premium received from the buyer. An options contract specifies all the terms of the contract, including the ticker symbol, number of contracts, expiration date, and the price to be met, which is called the strike price, for the contract to be valid. Even though it's called a contract, you are not really signing any papers or anything to obtain them. You just look in something called an options chain, which has all of those terms listed for you. Options chains can typically be found on the quote page when you search for a ticker symbol at your brokerage firm. You then determine which one you would like to participate and buy or sell based on the terms. So you really choose your own risk as well. Here are two different types pictured here. One is a put and one is a call. You can see that they each list the ticker symbol, the expiration date, and the strike price, and that way you have all the information you need to make a decision on what you'd like to buy. The buyer of a contract has rights. They do not have to wait until the expiration date to win the bet. If the price of the contract, called the strike price, is met, they can choose to exercise the contract early. They could also choose to trade the contract for a profit. They can also do nothing and let it ride if they believe the price will continue in their forecasted direction. In contrast, the seller has obligations. The seller's obligation is to deliver on the terms of the contract if the option is exercised or if it expires in the money. Sellers, though, also have flexibility. They can buy a contract to close out theirs, which can be done at a loss. They're basically paying to find another seller. Or they can choose to deliver on the contract come what may at the end. Most contracts are not held until expiration. This means that prior to expiration, those buying contracts choose to exercise them or close them out by selling to close. The CBOE reports that around 10% of all options are exercised, 60% are closed before expiration, and 30% expire worthless. It seems that the majority of people buying options buy them to hedge, exercise, or trade by closing before expiration. And we can definitely use this information to our advantage on both sides of trades. Please don't let some of the unfamiliar terms scare you away. You can definitely learn them. Options are very accessible. They are easy to buy, sell, and trade. They're very democratized, if you will. And they can actually reduce the level of risk and increase returns in your portfolio when they're used appropriately. This is because options offer lots of versatility. They can be used to reasonably speculate with known profits and losses. They can be used as hedging in the form of buying puts for downside protection. They can be used to generate income on long-term holdings by selling covered calls. You can also use cash-secured puts to receive money to purchase shares in the future at a lower price than they are now. There are also long-term options called long-term equity anticipation shares, or LEAPs for short, that extend out for 2 to 3 years in the future. So if you're bullish on indexes and long-term, you can use LEAPs to buy long-term calls on the indexes. You would be betting on a couple years of price appreciation. Before deciding what type of options contract to buy, the buyer first has to determine whether they believe the security is going to go up in the future or down in the future. The bullish side for upward movement of the underlying security of an options contract is referred to as a call. The bearish side for downward momentum is called a put. You can buy or sell options on most stocks and ETFs. Mutual funds do not allow options. So you can still pick which stock, ETF, or index you'd like to use these strategies on, meaning you have lots of choices on your options path. Options also apply leverage, so if there was something you were going to buy anyway, an options contract gives you a way to amplify that bet with less money. One option contract controls 100 shares of the underlying security. Let's talk a little bit about the risks. Many people think options are very risky, but like many things in life, that is true. If you do not know what you are doing, you can get into trouble pretty quickly, especially as you move up the level of options. As you can see here, level 1 is the least risky options level. Level 5 is the most risky options level. You won't get approved for anything higher than your experience level. So you're not going to get approved for level 3, 4, and 5 right out of the gate. For the most part, the lower levels are what you're going to get approved for, and they limit your risk by design. It is not impossible to get into trouble at these lower levels, but if you make sound decisions, it's less likely. There are ways to control risk. As the buyer, you never risk more than your premium that you pay for the call or put. As a seller, you can control risk by the types of contracts you sell and whether you own the underlying security or not. As far as where you can buy options, they are purchased in a brokerage account at a firm that has option trading capabilities. Even if the firm that you use is commission free for ETF and stock trades, they likely do still charge small commissions for options trades. But we are talking about 65 cents to $1 per contract total. The cost is really negligible compared to the potential gains. Most of the big name firms are going to offer options trading capabilities. Please make sure the brokerage house you are using is SIPC insured. They insure your assets if the broker were to go out of business. They do not protect against losses in particular investments, though. If your current broker charges you fees for buying and selling ETFs or stocks, it's probably time to move to a zero-cost broker anyway. I've used Fidelity and Schwab, and I like those platforms. I used to have an account at Vanguard, but Vanguard's brokerage platform is pretty antiquated as far as I know. TD Ameritrade's a pretty popular one with their Thinkorswim platform, pretty advanced, and Robinhood is well known for allowing options trading. It doesn't matter so much who you choose as long as they have that SIPC insurance and no-cost trades for ETFs and stocks. You can check your preferred firm to make sure of this SIPC insurance by clicking on the list of members on the SIPC website. As far as being tax smart, if you can do this in a tax advantage account, we always want to do that to fill up that tax advantage space first. The strategies I'm going to discuss in later videos are pretty much on the lower level of approval, which your firm should approve for beginners with no experience, and they can be done in a tax advantaged account. If you already have an account and you're already approved for options trading, well, you're done. If you are not, you need to go through your brokerage platform's process to open an account, apply for options, and fund the account. The options application and due diligence they take varies by firm. I've definitely heard of some firms calling you to verify information if you're applying for a high level with no experience, but for the most part, you just go through the process to apply for options with them, typically by reviewing and agreeing their options agreement, like this one, just an example. You'll likely only be able to get approved for the lower levels, but that's fine, because as I mentioned, we'll be starting out with those lower levels as the basics. I think that about wraps up the basics. I hope this overview helped. By the time I have the next video out in this series, you can have your account set up, approved for options trading, and ready to go. If you have any questions or comments, leave them below. Till next time.